This episode on the Sterling Blueprint, we've got one of the best in the financial industry. We've got Justin here from MJ Financial Chiefs. He's going to go through the ins and outs of buying a home and getting finance ready. So Justin, look, just give us a bit of an intro about yourself, what your background is and how long you've been doing the job for.
Yeah, so certified financial advisor, mortgage broker. We are based out of Narre Warren. We service all of Australia, specifically southeast suburbs of Melbourne. We've got a team of 5.
Who's in the 5?
Yeah, so we've got me and Michael, who are both certified financial advisors and mortgage brokers. And then we've got Dylan and Des. So if you've dealt with us, you would have more than likely dealt with those guys.
So it's a bit like similar to my team, myself. You know, there's 4 of us and it's quite close knit. I'm sure you have a bit of banter in the office and quite enjoy it.
There is a little bit of banter. I'm sure you've seen Dill on our Instagram. We love it. So yeah, really good. But yeah, the main goal is just to help people achieve their goals and help them make good financial decisions.
So I guess that probably sort of segue into what we're sort of wanting to discuss today. Obviously we're finding out there's always changes to stamp duty. That seems to be the government's way of constantly making change here.
Well,
right now, give us some examples of the stamp duty, what's concessions and where they sit.
Yeah, I mean, stamp duty is just a huge tax that we all get charged to purchase a place. So fortunately for first home buyers, there are concessions.
What can they spend up to?
Under 600,000, there's actually no stamp duty. So that'll probably save you about 25 grand.
Straight up,
yeah. So you've got that. And then between 600 and 750, there are concessions. So not fully exempt, but there are discounts on that.
And is there any discounts for age pensioners?
There actually is, yeah. So there are different ways to do that. You obviously need an age pension card.
That's fine with me. I mean, look, we get a lot, downsizing. We get people trying to work it out. I think I obviously explain to them that, you have a look go to a broker, you might be able to get a stamp duty concession. Sometimes though, if they're buying at say 800,000, I don't believe they comply. And once they go over a certain threshold, is that right?
There are thresholds that are involved, and that's probably why you come to us. Let's check the situation, because every situation is obviously different. And then we can make sure that, all right, well, this person can get some sort of exemption or a concessional exemption just based on, their place in the world.
So I guess that's probably jumps into that pre-approval sort of area I'd like to discuss with you. So we get a lot of buyers come to the open homes. Unfortunately, we deal a lot with that first home buyer market. They don't come across so confident when they're negotiating. They think, I've got to double check with my broker. To me, when you're trying to buy a home, you want to go to us as a real estate agent. Yep, I've got my pre-approval letter here. It's signed off. I'm fully pre-approved. I'm ready to buy at X. Can you give us some examples of how you make that streamlined and how that process works?
Yeah, for sure. And I think you would agree with me to say that if you go in to purchase a place and you've got a pre-approval, or if I've got a pre-approval, you'd be more willing to take my offer than somebody who hasn't got the pre-approval. So I think the important part of a pre-approval is you've got some confidence there to say, all right, I can spend 700,000. Then rather than just doing a calculation online that says, I've got a fair idea I can spend 700,000.
Is there a difference between someone being fully pre-approved, like loan docs sitting there, or not quite loan docs, but paperwork that's done rather than just a quick online estimate?
There's a few things. So every bank do it differently as well. So sometimes you can get a fully assessed pre-approval.
Okay.
Or if I could put an application with a bank and they don't fully assess it. So we're not fully aware of, so every bank's different, but we're not fully aware of if your income's fine, if they'll take your overtime, if they're going to worry about your credit cards or your HEX debt. Whereas we would look to take your loan to somebody who fully assesses the pre-approval. Then we know, all right, we know that you can spend 700,000, not we think you can spend 700,000.
I think it's crucial, even with us selling the homes and first home buyers, because I deal with them so often. I love it when they come up to me and go, no, I've got my broker, they're already on to it, we can spend X. And I think sometimes they're afraid of passing on the letter on the basis that they might feel like the agent's going to hamstring them to pay more. I sit there and go, if you can produce that letter, you've got a greater chance of actually securing that home than someone else.
Yeah, I mean,
because evidence-based.
Definitely, sometimes they don't want to produce a letter, which is fine. So that's when I'd be like, just get Jason to give me a call and I'll do the hard work on your behalf. Because then we can kind of talk and say, hey,
absolutely,
I'm confident I'm
I'm
confident we can get this done. We don't need to give you this paperwork, although you might want it sometimes. We can give it to you for sure.
Again, relationship, i.e. with a broker and with an agent, I feel when the broker's on the front foot, even if I've never met the broker or know the broker, I've had brokers call me on the front foot. Jason, you're dealing with, Janine. I'm just telling you now, she's a really good client of mine. She's fully approved. This loan's got a 98% chance of going through. We can't 100% say yes because, we never can. However, when a broker does that for me, I'm in full confident mode going, yep, this buyer can buy. Whereas, unfortunately, buyers do come across a bit sketchy, a bit unknowing, and that's totally understandable in this market where you may not know it. I guess that's probably another question to jump into. Give us an example on bridging finance. I wish, and I understand, obviously being in the industry, that bridging finance isn't that easy to obtain. Give me the reasoning probably to why, just for our viewers to understand why it isn't that easy to obtain and why the banks shy away from it.
Yeah, so you've got two options. We've got the bridging finance, whereas the bank will fund the property that you're selling and the property that you're purchasing. The issue with that is you've got to fund two loans, so the servicing generally can be a problem.
Okay.
If you don't have enough equity, they'll value your property and then they'll shade it to 80%. So they'll remove 20%.
So if it's $1 million, it's basically back down to 800.
Back down to 800.
If you've got a mortgage of 400, you've got only 400 G's of equity. If you're trying to buy it at 1.5, it probably just won't happen if you don't have serviceability.
It's conservative. They go super conservative because if you haven't sold this place, who's saying that it's going to sell? Like, it should sell.
Is there a time limit on how long you can have a bridging loan
Yeah,
for?
generally around 6 to 12 months.
Okay, so they wouldn't go over 12? No.
Not if you want to pay for it.
Yep, and okay, can you give me an example of, let's say you had $1 million in bridging, what are the sort of fees, monthly charge you're sort of looking at?
Well, generally, every
Sorry,
bank...
I'll put you on the spot here just with a number, but just an example.
Yeah, every bank do it differently. Some of the rates are normal or some of them are excessive, like 8-9%. And that interest gets capitalised into the loan when you sell the place.
Right.
So,
and that's hence the reason why it is harder to obtain.
it's definitely harder. And I think a lot of the time it's the equity and the servicing because you're servicing two loans, which sometimes, especially in this environment, it's hard to just service one loan. Now, the other option is to match your settlement dates. Now, to do that, we say sell your house first, put a 90-day settlement on there with the exemption or with the condition that you can bring it forwards.
Yep.
So you say, I'm happy to settle earlier, but I'm buying another place, and then you just try and match those settlement dates. And we see that's the thing that we see the most.
Yeah, right. And that's what we come across as well. We come across a lot of the time. I guess that probably jumps into deposits. I mean, this is a bit off the cusp, but okay, let's say you've got no mortgage, so you've got no loan, but your house is, say, selling at $1 million, and you want to go buy another house at $800,000, but you haven't got an $80,000 deposit because you're asset rich, cash poor. How would you go about trying to get that person a deposit for that new home?
Yeah, generally we use deposit bonds. Do you guys use that?
Yeah, I can give you a funny story about a deposit bond, which is probably right now a good one to go in. I actually stated about 2 years ago I'd never use a deposit bond or ever take one again. Yeah. I'm not sure if I think I told you this story. And my own personal reason, which is something I found out after the fact, was that a vendor doesn't have to pay me at settlement. They can pay me when I invoice them, and that could be after settlement. I had a vendor settle on a property without us even getting paid $1, and we didn't get paid nearly 2.5, 3 weeks after settlement date.
Okay. And
it was $400 shy because they felt like they didn't have to pay us the extra $400. They rounded it up. And that was purely because the deposit bond itself is paper form.
Yeah.
And then it was up to the conveyancer discretionary to say they wanted to pay the agent. That opened a couple of years ago to me, and that's why I was so furious with it, as you can imagine, that we weren't in the payment trail.
I think it's quite scary.
Yes.
For you guys. We see it a lot, and a lot of agents some don't know what it is.
Yep.
because whether they've
Is
just...
the bank guaranteeing the deposit for the buyer, is that right?
Yeah, essentially. We don't use so if you went to CBA, they're not going to give you a deposit bond. We have to go elsewhere to get it.
Can I ask why wouldn't they give a deposit bond? What's the...
They just don't do that. Yeah, so
They don't want the liability.
No.
It sounds like that. Sounds like.
I mean, the banks want is less the more risk you are to them, the more they're going to charge you.
Isn't that funny? The higher risk, the less serviceability, you get charged more. Yeah. So again, if you got more of a deposit, you get paid less.
Yeah, I mean, and that comes between equity and deposit. So if you got less deposit, that's when your rate is higher. And that's when you pay lender's mortgage insurance. And lender's mortgage insurance isn't...
What is lender's mortgage insurance?
Yes.
That's a great question to ask. You just said it. You said, what is lender's mortgage insurance?
So it's not the insurance...
LMI is what we all call
LMI,
it.
yeah, but it's not the insurance for you. It's for the bank. So it just protects them that if you don't pay and your house is then sold at a lesser value than what you actually bought it for, they've got the insurance on themselves and then they can get paid out.
Right. And is that generally on you haven't got enough of a deposit to put down?
Yeah, so if you don't have 20% deposit plus stamp duty and all the rest of your fees, so your conveyancing fees and stuff and that kind of thing, that's when you get lender's mortgage insurance.
That's a great, awesome takeaway just there from what Justin just said. I think if you don't have a 20% deposit, you will pay LMI. Justin, can I ask, LMI, is it a standard fee or is it a stepped fee? So let's say you had an 18% deposit. Do you pay less or do you pay the same as someone else only got a 10% deposit?
Yeah, exactly right. So great question. And we see this a lot with investors because not everyone wants to put in a 20% deposit.
Correct.
So if you did a 10% deposit, they are stepped, but if you did 88% deposit, it's 88% plus LMI, which ends up being just under 90%, 10%.
Yep.
Does that make sense?
That makes
Am I
sense.
explaining that correctly?
Yeah, it makes sense to me. Yeah, absolutely. So you do pay, I'm understanding
it'd be $5,000. Yeah, if you did 90%, a 10% deposit versus a 12% deposit, it'd be $5,000 difference in lender's mortgage insurance.
So
to paying an extra 2%, it's definitely
what I'm hearing there is, and what Justin's telling me now, and what I'm hearing for first home buyers and buyers alike, save more of a deposit and you'll pay less to the bank. That's what it says to me straight away.
What you're hearing, Jace, is come to me. We will strategize your situation. We'll work out exactly what kind of fees we need, what kind of deposit we need, what's the difference between putting this much deposit in versus this much deposit, and just making sure you're financially on a better situation.
Yeah.
So, it's more about the planning, I think.
So let's go with how often should someone revisit or look at their mortgage structure? So if you've got a client, let's say you've sold me, not sold me a house, I've sold a house to a client, they've used you as their mortgage broker. How often should they be re-engaging with you, or how often should you be re-engaging with them to try and help them save money on readjusting their mortgage structure, i.e. they might have a couple of credit cards or loans that they should be paying out by using equity? Or can you do that? Can you use equity of your home to pay out another loan you've got, i.e. car or credit card?
Yeah, so a lot of questions there, Jace.
Yep, so there's a few questions. I'll take that back. Let's go this way. One, can you use equity out of your current home?
How often? I like the how often one.
Yeah, how often? So how often should you reconnect?
Yeah, so basically we reconnect. So we've got systems in place where we reconnect. We've got systems in place where we reconnect every 6 to 9 months.
Yep.
So as soon as you buy, in 9 months' time, we will reach out and say, hey, we've reviewed your situation. There's a discount available. There's not a discount. We've done a valuation and now it's higher. So if you were in lender's mortgage insurance, then we can refinance you out of that. And yeah, you don't save on the lender's mortgage insurance, but your rate's going to drop because now you're less risk. I mean, we can value your place 6 months later. And that could show a complete different, because it's an online valuation, and they're not, Not
100% most times.
Which can be a good thing.
Can be a good thing.
If it values
can be a bad thing. Yep.
Yeah, if it values higher, well, if it values lower, we don't say anything. But if it values higher, then we can put you on a cheaper rate.
I guess the other question I'd ask there is, okay, you're a year later, you've paid down some of your loan, and also can you use some equity to pay off, say, a separate car loan or a credit card? Could you do that as well?
Yeah, for sure. So we can use equity for a lot of different things. And for those who don't know, equity is, say I have $1 million house, we've valued it, it comes out as $1 million. We've got a loan of 800,000, we've got 200,000 there in equity. So the equity is the difference between your loan and how much you actually, the value of your property. Generally, you can refinance anything because we want to stay out of that lender's mortgage insurance environment at 80%. So if it was worth $1 million, our max loan would be 800,000. Yep. So say that we currently had a loan of 700,000, then we've got 100,000 there that we can take out.
Gotcha.
Now, we either take that money out and we can restructure your loan and use that as to purchase investment properties or use it for investment purposes. And we would structure it in two different loans. So you'd have your $100,000 and then your $700,000. And the reason for that is because the $100,000 can then be used for tax purposes. So we can then claim the interest on that.
There's some great takeaways there. It's fantastic. The last one I think we'll end on, which is something I'm coming across a lot in my own personal experience. I think even as the generations get older, the bank of mum and dad, I'll call it the bank of mum and dad now, let's call that the guarantor loans. Are you seeing guarantor loans come more regularly than they used to, given how many years you've been in the industry for? But also, give us the pros and give us a couple of cons of a guarantor.
Yeah. And you mentioned that. I have been in the industry for 8 years now.
Long enough.
Our business has been 8 years, so I've been in there for just over 10 years.
There you go, so a decade,
Yeah. Guarantor loans I've actually seen quite a lot lately.
Yep.
Due to people don't have the savings. Yep. So if you don't have the savings, we can use a security guarantor, which is generally a family. So say your father or your parents can be your guarantor. Now they have to put their house up as a security. Now the issues with that is if there's a loan on there, it works off equity or how much money they've got in it. So if they've got a higher loan, they're probably not going to be eligible for that.
But if they've got, let's say the house is worth, I'll just say $1 million, just as a round number, it's easy to work off, unencumbered, no loan.
Yeah, perfect.
And they want to give their daughter or son, get them out of that LMI, say a $200,000 guarantee. Is that something example?
Good example.
Yep.
They don't give anything, obviously.
No.
They just put a hold on their property. And how it works is if we could borrow 100%, so if the daughter or the son wanted to buy for 500,000, now they're just guaranteeing 20%. So we split the loans in two. Yep. So you've got a 20% plus fees, stamp duty, conveyancing, and then you've got your 80% loan. So the 80% loan is the son and daughters. Then the 20% loan, that now becomes secured by your parents' property.
Or the guarantor themselves.
The guarantor.
Yep.
So they're not securing the whole 500,000. They're only doing the 20%.
And that generally is used, I'm assuming it's generally used to get rid of the LMI, but also to be able to help the borrowing capacity as the banks, they're saying to the bank, well, we're going to shore up the property here is we're going to put up our property as collateral.
Well, that gets rid of the risk, which means you get a better rate. Better rates means better serviceability. No lender's mortgage insurance. Now that just gives them.
They're the three big positives, aren't they? They're pretty big positives
Massive.
for a buyer. What are the negatives? So, and I don't believe there's any negative for the actual person getting the guarantee. Having the negatives are to the guarantor.
Yeah.
What are the negatives there? What do you see as the negative or the pitfall for the guarantor?
Now
that they should be aware of when doing.
Yeah, obviously, if your son and daughter doesn't pay the loan, then because we've split it into two, you're responsible for that smaller loan. Now, if worst comes to worst, the first thing the bank's going to do is go to sell their house. Now, if there's money left over, that's when they will say, hey, first they'll go to your son and daughter and say, hey, where's the money? You've got to pay this. If that doesn't happen, that's when they might come for you.
And that'd be pretty rare.
I think
that would be. I would imagine that's a pretty rare scenario that's ever happened.
Yeah, I spoke to a bank manager the other day. They said we would try to avoid this at all costs.
At all costs, because they don't want that to look. Again, that would look bad on the bank, just trying to take the money off of mum and dad, and
they don't want to be.
They don't want to be doing that.
Yeah.
Is there any other pitfalls for a guarantor? If they go to sell their own home?
So you're obviously using it as a security. So if they want to sell their place, they can't actually do that because there's a hold on it. Your security.
It's like a caveat, essentially.
Yeah.
Isn't there?
Now we can swap it. So if they want to sell and then go somewhere else and buy another place, we can just change the security over. So we can just
Okay.
You can sell the place with the caveat on it that you're going to secure the new place that you're purchasing. We've done that multiple times.
Okay.
So it's not a
And
complete.
how quickly are we talking? Does the guarantor come off the loan? Does that determine, is it a length of time? Is it a certain amount of money?
Yeah, no, it comes down to, again, we'll do some valuations, and if your house has increased in value, then we can take them off. Because if we're doing 100% lend, now the bank's not going to take them off because they're like, well, I've got 100% risk here. Until you can reduce that risk, and you do that by either paying down the loan or reducing it. Say we've got 10% equity, then we could do it if at worst case. But yeah, sometimes like I can get a guarantor off in 6 months. If you're buying an apartment or a unit that doesnn't really go up in value, then we're probably on there. I've got some that's been there for 3 years. Again, we review every 9 months, so we're actively trying to get them off. But like if the value doesn't come back,
And you're right about a unit. I mean, my first ever home, I think I talked this on this last week, was that my first ever home, I actually essentially lost money. I sold it for $3,000 more than I paid for it 4 years later. And I mean, when you talk, plus stamps, plus improvements that I did, I probably lost to 30 grand, plus, interest just on my loan, probably talking 30, 50 grand I probably lost in that whole time.
It's huge. And I think you see a lot of first home buyers buying townhouses with their partners because it's affordable. I mean, if we can save a little bit more and buy a little bit more, like you don't want to give up your stamp duty exemption. And the first home buyers, there's schemes there that can help you. If you're only in there for 2 years because you want to have a kid, all of a sudden, like you've got no room, but you can't afford to get out.
Yeah, geez.
So we see that a lot as well. Yeah. But these are the things that we strategize and we say, hey, I just want to buy for 500 because I don't want to spend all my money. I'm like, yeah, but what's going to happen in 2 years' time?
Yeah, you got to have a plan, don't you?
Yeah, correct.
Justin, it's been a pleasure. Thanks once again. Obviously, MJ Financial Chiefs, if you're obviously looking at buying or selling and you want some financial advice, give them a call, give them a hit, and I'm sure they'll be able to service you.
Thanks for having us, Jace.
No worries.
Appreciate it.
Thanks, Justin. Appreciate it.
Thanks.
Thank you.